Right now, as we speak, shares of Beyond Meat are trading at exactly 86 cents. The market is live, the order books are flashing, and what we are seeing is a stock trying to find its footing after a turbulent session. We are looking at a movement that has the stock hovering just about 1.0% off its intraday lows, but critically, it sits roughly 17% below the session's peak. The volatility here is palpable. You are not looking at a stagnant chart, you are looking at a battlefield where bulls and bears are wrestling over every fraction of a cent. The volume has already exploded past 169 million shares, completely dwarfing the average daily volume of around 77 million. This is not normal trading behavior. This is a liquidation event for some and a high-stakes lottery ticket for others. When you see volume turnover this high relative to the float, it tells you that the ownership structure of the company is rotating in real time. The expectation for Beyond Meat has been, for a long time now, one of inevitable decline. A company that was supposed to be the future of food, but found itself trapped in a cycle of cash burn and fading consumer interest. That is the expectation. The reality, however, is far more nuanced and, frankly, much more dangerous for anyone betting blindly against this name today. The reality is that despite the collapsing share price, the company just posted its first revenue growth in quarters and significantly improved its margins, suggesting a pulse where many assumed there was only a flat line. This disconnect between the bankrupt soon narrative and the turnaround in progress data is what creates the opportunity and the risk that we need to analyze. Most people looking at a stock trading under $1 assume it is game over. They see a penny stock and they walk away. But if you look closer at the order flow, you see something different. You see aggressive accumulation in pockets, countered by massive institutional selling pressure. It is a tug-of-war that usually precedes a major move, either a final flush to zero or a violent squeeze higher. We need to strip away the noise and look at the mechanics of what is happening right now. The price action today is being driven by a mix of fear regarding a recent trademark legal loss and speculation on a short squeeze. When you have a stock with short interest as high as Beyond Meat's, every tick upward causes pain for a massive group of traders betting on the company's failure. This dynamic creates a coiled spring effect. We are seeing this play out across various platforms, whether you're watching the tape on a professional terminal or tracking the sentiment on retail apps. Speaking of how individual investors are approaching this, the divide is fascinating. You have the aggressive speculative crowd, likely using platforms like Robinhood, where the interface encourages quick execution and the focus is often on momentum. These traders are looking at that 169 million share volume and seeing a momentum play. They are utilizing Robinhood stock trading features, perhaps even dabbling in Robinhood crypto on the side, but right now their eyes are glued to BYND. They are buying the dip, hoping for a rip. On the other side, you have the more conservative capital, perhaps sitting in accounts at Fidelity. A Fidelity client, someone who maybe holds Fidelity ETFs or uses Fidelity wealth management services, is likely looking at this chart with horror. They are seeing a breakdown of fundamental value. They are looking at the debt load and the legal liabilities and staying far away. This clash between the Robinhood momentum crowd and the Fidelity value preservation crowd is what creates this chaotic intraday chart. It is not just numbers moving, it's a collision of two completely different investment philosophies. Let's widen the lens and talk about the sector context. It's easy to get tunnel vision on one ticker, but you have to understand the liquidity environment. When you look at the broader markets, we are seeing capital concentration in megacaps. Investors are piling into names like Nvidia stock or Apple stock because they want safety and growth visibility. Tesla stock continues to dominate the speculative EV conversation. In that environment, a microcap struggling food company like Beyond Meat becomes a distinct outlier. It is not a safety play. It is a distress play. And distress plays require a completely different set of analytical tools. You cannot value this purely on price to earnings because there are no earnings. You have to value it on survival probability and asset liquidation value. That is a grim calculation, but it is the honest one. For those of you engaging in online investing, perhaps using Schwab Intelligent Portfolios or similar automated tools, you will notice that algorithms often filter out stocks like this. A Schwab Intelligent Portfolio is designed to minimize volatility, and Beyond Meat right now is pure volatility. It is the antithesis of a passive investment. It demands active, almost minute-by-minute monitoring. Now let's address the elephant in the room, the recent news cycle. The stock is under pressure partly because a jury verdict finding the company liable for trademark infringement, with damages significantly higher than the market cap would comfortably allow. We are talking about tens of millions in damages in a time when every dollar of cash is vital for operations. This legal blow reinforces the bear case, that the company is bleeding cash from every orifice. However, and here is where the contrarian take comes in, the market may be over-discounting this news. The stock is trading at a valuation that implies bankruptcy is a near certainty in the very short term. But if you analyze the Q3 earnings report released recently, the company actually reported net revenues of $81 million, an increase of 7.6% year-over-year. That is a massive deviation from the trend of double-digit declines we have seen for 2 years. Gross margin swung from a negative figure a year ago to a positive 17.7%. That is not a company that is dead. That is a company that is fixing its operations. They are selling less product but making more money on what they sell. They are cutting costs, closing inefficient lines, and optimizing their supply chain. This is the classic shrink-to-grow strategy. It is painful. It looks ugly on a stock chart, but it is often the only path to salvation. When you invest online, you are often bombarded with headlines that lack this context. Investing sites will blast legal loss or stock crashes, but they rarely explain the nuance of the operating margin improvement. If you are using a tool like SoFi Invest, you might see the social feed lighting up with panic. SoFi investing platforms are great for seeing what the crowd is thinking, and right now, the crowd is panicked. But as a smart investor, you have to ask, is the panic priced in? At 86 cents, is the market effectively pricing the equity at zero? If the answer is yes, then any positive news, a successful appeal of the lawsuit, a debt restructuring, a new partnership, could cause a re-rating that is violent and upward. This is the tension I mentioned earlier. The expectation is death. The reality is a company that is fighting harder than it has in years. Let's pause for a moment and consider the mechanics of trading this. If you are using interactive brokers, you might be looking at the cost to borrow shares. Interactive brokers' trading platforms are favored by sophisticated traders who short stocks, and the borrow rate on Beyond Meat has been historically high. This means it's expensive to bet against the stock. Short sellers are paying high interest rates for the privilege of holding a short position. When the stock dips to 86 cents, they are in the money, but they have to decide when to cover. If they get greedy and hold too long, and the stock pops back to $1 or $1.20, their profits evaporate and they are forced to buy to close, fueling the rally. This is the squeeze mechanic. It is not about the fundamentals. It is about market structure. Whether you are on the Interactive Brokers platform, worrying about Interactive Brokers fees, or using a free app, this structural dynamic affects the price you see. I want to pivot to the business itself. What does Beyond Meat actually do today? We know the burgers, we know the sausages, but the business model has shifted. Initially, it was about ubiquity, getting the product into every fast food chain and grocery aisle possible. That failed because the mainstream consumer didn't stick with the product. Now the pivot is towards health and wellness. They are reformulating products to use avocado oil, lowering saturated fats, and getting certifications from the American Heart Association. They are trying to move from fake meat to healthy protein. This is a critical distinction. If they can convince the consumer that this is not just an ethical choice, but a health choice, the addressable market expands again. We have seen them launch the BYND IV platform, which is their newest iteration of beef. The feedback has been better, but the question remains, is it too late? The partnerships are also